All right. So I did successfully, I believe, set up Brightspace, believe it or not. Let's go take a look at it real fast just to make sure. It's hard for me to tell from my side um, whether it is working correctly or not. All I know is that it appears to be working correctly on my side. So I'm going to go open it up again so you can see what I've done. And I mean, ideally, everything should be in one place, but I'm still recording or placing the videos in YouTube just in case there's an issue there. Let's see, Brightspace. Yeah, you never know with videos and these online services. Sometimes it works well and sometimes it doesn't. Sometimes space is a problem. So I'm hoping that that won't be an issue here, but you never know. There's certain systems like Moodle doesn't do a good job with videos, but Blackboard does. So it remains to be seen if there's going to be a problem or not. Anyway, so let's look at this. So ideally, somewhere in here, we will find all the readings. And now that I'm looking at it, I'm sorry, I'm not sure. Oh, here we go. I see what they've done. So those little pictures tell you where the weeks are. So the first week I've got session one is just our PowerPoint slides. This is the assignment and this is the video. And then we have week two, same thing. This is last week, of course. And now for this week, look what I did. I did something wrong. I forgot you're supposed to turn off this eyeball or whatever this thing is. So, okay. Because I know somebody had trouble finding it. Now I know why. Sorry about that. But I do have it on Blackboard still if you want to look there. So, okay. So I'm an amateur. I was just learning how to use this system. It looks like I forgot to turn off that eyeball thing. So that's why it wasn't available. So I'll try to remember that going forward. But anyway, week three, we have the notes here and the assignment. This week, we'll be looking at swaps. And like last week, we focused specifically on forwards and futures. This week, we'll look at swaps. And then after that, we'll spend a significant amount of time with options because options are a much more complex security than any of these other ones. And they will require a lot more time. All right, now the swaps are, interestingly enough, the swaps are really just a simple extension of forward contracts. In a lot of ways, they're really just the same thing, except with multiple maturity dates. So it isn't radically different than what we did in our previous chapters. And also, like with forward contracts, there's no actual cost associated with entering into a swap contract. It is an agreement, or I guess you can think of it as a series of agreements. And what we're essentially doing is trading cash flows at future dates based on the difference between two reference variables. Typically, those reference variables are interest rates or currencies, but it could be anything. They are over-the-counter products, which means they can be customized to any needs. You do not normally see swaps trading on organized exchanges because every user basically has different needs. So, unlike with forwards and futures where you have both, the forwards are traded in the over-the-counter market, futures are traded in the through exchanges. You don't see exchange traded swaps. They're just too specialized to justify it. The exchanges really only make money when they have large volumes of trading. And so that's why they've never really offered swaps directly. Now, having said that, you might be able to find derivatives based on swaps through exchanges. For example, options written on swaps, which are known as swaptions, might be available through organized exchanges. We'll see as we go along, but swaps themselves are not normally available through organized exchanges. They're completely customized to the needs of the individual. And unlike the others too, with swaps, realistically, they're going to be used for hedging purposes. I can hardly imagine that speculating with swaps is going to be a very efficient way to go about speculating on whatever it is you're speculating on. If you want to speculate, there's a lot of simpler ways to do it than using a swap. So I'm going to guess that it's very unusual that you would see swaps used for speculation. Speculators have a tendency to use options because they're so heavily leveraged but sometimes forward contracts as well. So anyway, let's get the notes open. Oh, you know what I want to see? How does this, let me see if I can download this. Ooh, oh, I see what it's offering to do. Okay, no, I don't want to do that. I'll tell you what, I find that when I'm doing teaching online, it's just easier to deal with the PowerPoint slides than the PDFs. The PDFs are good because what happens here is that since I'm using a PC here, anytime there are graphs or equations, they can get distorted if somebody opens them up with a Mac. And so with PDFs, you don't have to worry about that. But I find that the PowerPoint slides are easier to, well, to not only read through, but also to write on when I'm doing online classes. So I'm going to stick with the PDF files. I mean, sorry, the PowerPoint slides here, but I believe the ones I put on Brightspace are PDF because that way, if you're using a Mac, you'll not have a problem with the graphs or the equations, which sometimes does happen because they're not necessarily compatible with each other. Well, all right then, let's get to this. And for this one, oh, you know what I forgot to do? Oh my God, you know what? By the way, I don't remember, did I email any of this stuff to you or did I just put it on Brightspace? I'll tell you why I'm asking is because I wanted you to have a copy of this template, which I guess I'd better put there now. Because it'll take too long to do this without the template. Let me just get this in here. I actually did forget about this. I'm going to add this right now. It's called Swaps Template V3 for version 3. And it's basically a bunch of data or information that's set up so you can easily and quickly see how swaps are priced. It's important to have it already set up in advance because otherwise we'd be here all night getting it set up. There it is, perfect. So I'll get rid of this eyeball thing. Okay, so I'm going to download it now to see what it looks like. Oh my God. See, now this is not good because it's trying to send it to me. Let me just see something here. I wonder if I can tell it. I'm getting annoyed here because I'm starting to wonder, why is it trying to send this to me as a PDF? I didn't realize that was going to happen. This is meant to be.
Download as an Excel. Yeah. The swaps template.
Just now, when I tried to download it, it tried to give me a PDF file. What is that all about?
Well, that's your computer identified as something
else.
Oh
my God.
I downloaded the Excel.
Oh, well, how come it won't work for me? I put it there. See what I mean? It's assuming PDF, and I don't want PDF. This is ridiculous. Well, if it worked for you, I guess I'm okay with that, but I just think it's absolutely idiotic that it's trying to insist that this is some kind of a.
Did you click on download?
I don't know what's going on. I'll have to call the schoolroom. This is the first.
But I have it as an Excel, so
okay.
Yeah.
That is unbelievable. It's not like I mislabeled it or misnamed it. It says right there, XLSX, and yet look what happens when I put it there.
If you download it, it might download like an Excel.
No, look, watch what happens. It's offering. Oh, you mean you want
the view, but it's not downloaded yet.
Well, what am I supposed to do? I keep hitting
save it and then.
But if I save it, it's trying to save it as a PDF file. I should have, you know what? I should have realized it was too good to be true.
I don't know.
And now it won't let me minimize the size of the screen. So I have now lost 100% of my confidence in Brightspace. As far as I'm concerned, the honeymoon is over. Just to be on the safe side, I'm going to go back to emailing this stuff to you. I'll post it here too. but there's obviously something wrong with it. It's just, technology doesn't like me. It doesn't work for me. It never has, it never will.
So when you see it, it looks like it's a PDF, but when you download it, it will download as an Excel.
Okay, I see. So in other words, I had to click on these dots and then hit download. Why is
You
this?
have to click on the, yes, on that, click on that, and then save it. It's gonna open it as a Excel.
No, it's trying to save it as a PDF. Look at this.
Does it say that?
Yeah, it does. It says,
Oh,
yeah. And it's not
that's so
offering me any
strange.
other, nah, it's garbage. But anyway, I was able to convince him by coming over here. But I mean, what is the point of that? All right, anyway, I don't want to waste the whole night with this, but it's just typical for my experience with technology.
Options.
It just takes it on itself to assume what you want incorrectly, and it doesn't give you the choice of fixing it. Isn't that?
Oh, I think you changed something, because now I downloaded it as a PDF, but when I downloaded first, it was an Excel.
No, you know why? Because from what I'm seeing here, if you download from these three buttons, it'll work properly. But if you download from this button, it will not work properly. God only knows why. I don't even want to ask questions. All I know is it doesn't work. Therefore, make sure you use the three dots. Otherwise, you're going to get stuck. And the PDF file is not going to do you any good.
Okay. Yeah.
Because
I
you
downloaded using the cloud. If you use the cloud, it will be an Excel.
Where's that?
It's above. If you maximize your screen,
Uh-huh.
it's above the arrow, outside of the gray area, above the arrow.
Up here?
Oh, you don't have it.
Oh.
You have to maximize your screen. It's not maximized.
Oh, are you sure? I thought this
Yeah.
button maximized it.
Oh, I don't know. I have a cloud, but you don't.
No, of course
There's a
not.
little cloud.
Why would there be
Yeah.
I don't, okay.
Yeah.
Are you using a Mac?
No, I'm using a PC.
Where do you see the cloud?
It's right above the download error. It's right above, but I don't have this like visible app, existing, create new, and maybe on the three dots on the right side, right there. Yeah, maybe there. If you click download there.
Oh, I
It's
did, and it
download.
did. That actually did work.
Oh, right there. It's right there.
But I'm not seeing any clouds.
Oh yeah, but it's because you're an administrator and I'm not. So
Uh-huh.
I don't have those like visible add existing create new. That's for you. So I have a little cloud instead of that.
Oh.
It's a little cloud to download.
Oh. Well, it downloads in Excel for you then. Is that what you're saying?
Yes.
All right,
Yeah.
that's all that matters. The rest of the crap is irrelevant. All right. What a joke. I like all technology. It's a joke. But anyway, let's get back to this. Let's see how just out of curiosity, see what happens if I actually dare to download the slides. Oh my God, it actually figured out what I wanted. I don't know how. That's right, go away. All right, well, anyway, so we can get started now that we got this nightmare straightened out. So, all right, so interest rate now, there's many, many different kinds of swaps because they're customizable. In principle, you can have swaps on anything you can imagine. But the most popular ones are interest rates and currency swaps. In fact, that's how this whole thing got started in the early 80s. There was a situation where, I don't remember the exact details, but either the IMF or the World Bank needed to borrow funding in one currency. And IBM also needed a different currency than the dollar. And there were some restrictions for some reason on one of them. And they got together and said, well, here's what we'll do. We'll borrow each other's currencies and lend them to each other directly. In fact, I think Wikipedia has this. Let's just see what they have to say. I seem to remember seeing an article there. Here we go. Swaps were first introduced to the public in 1981 when IBM and the World Bank entered into a swap agreement. Oh, I thought they had more of all of the details. Yeah. Well, what happened was there was some, for some bizarre reason, there were restrictions on what each one of them was allowed to borrow, or it just, there were some currency controls going on, and so each one was able to acquire the currency that the other one wanted, and then they traded directly with each other. So that way they were able to get what they wanted, and so the idea caught on very quickly. Because, obviously in Wall Street, they would have seen this and said, we have a lot of clients who would love to do something like this. Why don't we set them up and make ourselves some nice money in the process? So here they've got an unusually complicated one going on. There's A, B, and a bank. They have exposures. A here, for example, you can see they have entered into a scenario where they borrowed at a floating rate. And there's a bank over here who's borrowed at a fixed rate, but they would like to reverse that. The bank would like, or sorry, B would like to actually borrow LIBOR plus some fixed spread, and A would like to do the opposite. So they get into an agreement with this bank, which is acting as a swap dealer. And what you really want to pay attention to is the net differences between all these cash flows. So if you see, for example, the bank in this example is collecting 8.65% from A, but they're only paying 8.50 to B. So there's 0.15% right there that goes into their pockets. And then on the other side, they're getting LIBOR plus 70% from B, and they're only paying LIBOR plus 55%, 0.55% back to A. So there's another 0.15%. So they're making 0.30% on this deal. As long as there's no default, they're going to make money no matter what happens to LIBOR. And that's exactly what they're after. Whereas A, as far as they're concerned, they're willing to pay a premium in exchange for the convenience of paying fixed instead of floating. Because let's say they're worried that LIBOR is going up in the future. They don't want to keep paying a floating rate if they can help it. So by entering into this agreement, you can see that they're receiving LIBOR plus 0.55. The payments that they're making add up to LIBOR plus 1.50 plus another 8.65. So the net difference there, what's coming out of their pocket is 9.60% fixed instead of a floating rate. And B, whereas before they were paying 8.5 fixed, now they obviously believe that LIBOR is heading down. And so they've arranged this so that now they're paying LIBOR plus 0.70. So none of this could work if A and B had the same outlook on interest rates in the future. But from their perspectives, A and B, they've changed their liabilities from something that they did not want into something that they would prefer based on their outlook in the market. The bank facilitates all of this, and they collect a premium for doing this. Just like, when you buy currencies, you have to expect to pay a small premium. You pay a slightly higher price for a currency, and then you receive a slightly lower price when you sell it, and the dealer puts the difference in their pocket. Now, up here on top, I see they've got a list of some of the other swaps that you could potentially get into, which we're not really going to focus on these at all, but it's interesting to note that they do exist. Interest rate swaps we'll be doing, currency swaps, a basis swap is two floating rates, but they're two different floating rates. Otherwise, it wouldn't make any sense. Like it might be LIBOR and the Fed funds rate or something like that. Commodity swap means you're basically swapping the returns to a commodity or a basket of commodities. And they mentioned here that oil is often the commodity of interest. And you might be trading that for a fixed rate of interest or possibly a floating rate of interest. Credit default swaps are different. These are credit risk securities. These are designed to provide protection against default from, let's say, you own a bunch of bonds in your portfolio, and you're worried that the issuer of some of these bonds might default. You can buy protection in the form of a credit default swap. So it's a little bit different because it's more like an insurance policy than a true swap, because you're paying X% every quarter, let's say, to the financial institution, and you only get a payment back from them if one of your bonds runs into trouble. Possibly it requires a default for you to get a payment, or possibly just a downgrade from the credit rating agencies. Inflation swaps are really meant for, it's still kind of a fixed for floating rate thing, but it's based on change in the prices of certain assets, possibly an inflation index like the CPI. But there's all kinds of it, and there's more than just this. They just want you to see that these are the most commonly traded ones, but there's so many more that you could get into. Whatever you want, because these are completely customizable, you can enter into any kind of swap you want. Like if you're interested in like currencies that don't trade very often, or if the timing of the payments is very strange, or, there's all kinds of bizarre swaps. In fact, maybe we could find an article here about some of the most bizarre types of swaps. Oh boy. Yeah, this is interesting because they're trying to tell you what's going on with swaps now that LIBOR is about to disappear. Now, I thought somebody might have come up with a list of very strange kinds of swaps, because I know they exist, but also the swaps themselves, the terms and conditions can have different features built into them. The ones we'll be looking at, the standard ones, might have an agreement set up where, let's say, every 6 months for the next 5 years, you make a trade of cash flows based on 2 different interest rates. But you often have some of these swaps, you may have the right to, for example, extend the swap into the future if you want to, or maybe you can cut it short if you want to, or maybe you have a contract which lets you get into the swap if you decide to in the future, or with an option, it gives you the right to enter into a swap, but not the legal obligation. So there's all kinds of different possibilities. But anyway, we're going to look at the most standard types, the so-called plain vanilla swaps. So what are we doing here? We're looking at the key features. We're looking at how they're priced. We're learning how they're used for hedging purposes, and what other kinds of swaps are out there in the marketplace. Well, we'll start with interest rate swaps. And as Wikipedia kindly pointed out here, these are the most common. It's a derivative security, and typically, but not always, 2 counterparties periodically exchange cash flows based on the difference between 2 different rates of interest, which are normally 1 fixed and 1 floating rate. There could be 2 floating rates, but then they have to be 2 different floating rates. In every case, they're based on what we call a notional principal. The amount of money underlying the swap is called the notional. We need that number to help us figure out the actual size of the cash flows. Okay, so in other words, it matters a great deal if the notional principal is $1 million versus $10,000. So that has to be established in advance. But that notional principal never actually changes hands. So let's say we enter into a fixed for floating rate swap based on LIBOR and some fixed rate. Yeah, I mean, and let's say one turns out to be 6% and the other 7%. Well, clearly somebody is owed 1%. The notional is what tells us the actual dollar amount. Okay, so that's why we need to know the notional. All right, so now we're going to assume, just for simplicity, that we're still using LIBOR, although soon enough that won't be true anymore. LIBOR was. I guess it still is. I don't know if they're going to completely discontinue it or just not use it for derivative securities contracts. It's the London Interbank Offer Rate. And essentially what happened was, every day, the British Bankers Association would contact the 16 top banks in London, and they would ask them what rate did they charge for overnight loans or short-term loans from other major banks in London. And all 16 of them would provide a quote. And what they would do is they would take all but the largest and smallest quotes and then average them out. and that number would be LIBOR for that day. The maturities used to run up to 1 year, and there was one separate LIBOR rate for every major currency. So there was a dollar LIBOR rate, there was a pound LIBOR rate, there was a euro LIBOR rate. So depending on which currency you were borrowing or lending, there'd be a different LIBOR quote for that currency. Okay, so there are different maturities and there are different currencies available. And so many, many derivatives contracts were based on LIBOR because it was very flexible. It was very convenient. It was quoted every day. It was easy to find the value of LIBOR. Sadly enough, the crooks at Barclays Bank made that all impossible because they were cheating their clients by manipulating the LIBOR numbers. And so that took care of that. That LIBOR market had been around since the 50s. And all of a sudden, I guess it surprises me that it took, that long for cheaters to try to rig the system, but it finally happened. And now we need to use something else. So the awkward part is that you're going to end up with a different version of LIBOR for every currency. In other words, for the dollar, we're going to use something called SOFR, which stands for Secured Overnight Financing Rate. And then for other currencies, they'll have their own equivalent version of this. So the thinking is that this SOFR rate is something that can't be manipulated by traders. The problem with it is that I don't think it has more than maybe 1 or 2 maturities available. By the way, what are we looking at right here? I just wanted you to know, this is a derivatives class anyway. We should know this. The Chicago Mercantile Exchange website. Oh, it was January. Okay, so we just switched over to SOFR. Okay. Well, so anyway, in the Chicago Mercantile Exchange, if you go to their education page, they have links to all kinds of wonderful topics that you can read about and even take online courses and learn more about all these wonderful securities. Now, of course, the exchanges benefit from large trading volumes. They're hoping that the more you know, the more likely you are to trade with them. And so that's why they're willing to make all this stuff available to you for free. So this is where they're going to talk about SOFR if you're interested in it. I'm not sure if they're going to discuss swaps though. Let me just see something here. It might be interesting to find an article.
We have a line of credit, and so they, on the contract, like we did like years ago, it said that we were going to be charged SOFR if something like, but I don't know what happened.
Oh, you mean the contract said if something goes wrong, we'll use SOFR instead of LIBOR?
I don't remember if there was something, it was mentioned there, and yeah.
Wow, that's interesting.
And then suddenly we had a statement, and then we had an amount that had SOFR and an amount that said LIBOR, and now every time we borrow, we have to choose one.
Oh,
I think, but before it was just automatically LIBOR.
I see.
But what happened that made that, that?
See, now, of course, here's the rub. This is only available for US dollars. So they're doing it now. Yeah, I would have thought so. It says here, according to this is, by the way, I didn't even know Capital One did this. They have their own information page here. And well, they didn't mention anything about corruption here, but so here's a nice little table which explains the differences between the two. The SOFR is considered to be a risk-free rate. It's an overnight secured loan. It's the rate charged on a repo, where one bank can borrow from another one by using a treasury security as collateral. So it is really and truly risk-free. And so it's a very low rate. In fact, I'm not even sure if we can find the current SOFR rate on the internet. Hold on a second. Oh, there it is, 0.29%. And it does go out to 180 days. Look at that. How do you like that? Look at that. There's a SOFR. Look at this thing. How do you like that? '30s, 90, and 180. Well, that's not so bad. I mean, LIBOR went out for a year, but this isn't too bad. They should be able, the market should be able to use this for swaps. Huh, interesting. Okay, so anyway, so they're telling us here that LIBOR was, interbank lending, although I guess SOFR is too, when you think about it. LIBOR is unsecured. There was technically some credit risk there. In fact, a lot of swaps were priced based on the assumption that LIBOR is equivalent to buying debt from a AA corporation. So was not considered to be completely risk-free, whereas this one would be. And over here it says based on bank submissions incorporating a limited number of actual transactions. In other words, the 16 largest banks, expert judgment, right? That's where the manipulation got in. And over here, transactions based. These are 100% based on market transactions. According to this, this is based on $500 million worth of daily transactions, whereas this one is based on $1 trillion. Ooh. Forward-looking term structure for LIBOR, overnight backwardly. Now it says here, no term structure currently as of 2021, but we just saw that it actually now apparently is available up to 180 days. So there is kind of a term structure, 30, 90, and 180 days, which, didn't really exist before. By the way, too, because this rate is going to be very closely related to the Fed funds rate, I'm sure the Federal Reserve banks will have their own research papers about SOFR if you're interested in looking at them. But the one thing that we can't get around here is that at the moment it's only available in dollars. So if you want to do a swap in euros, for example, you'll have to use the equivalent of whatever they're using in Europe for their swaps. But anyway, so these notes were written when we're still using LIBOR, and all of the fundamental concepts are exactly the same. So we'll continue to refer to LIBOR, even though we know that it's no longer LIBOR. The logic is exactly the same. So we have a fixed for floating rate swap. The fixed rate that is locked into place is called the swap rate. So a corporation issues $100 million worth of debt with a maturity of 5 years and an annual coupon of LIBOR +2. Now, that means they're committed to paying their lenders a floating rate of interest. Now, in the beginning, they may have thought that made sense. Maybe they don't think so anymore. So the thing that scares them is that rates may go up and they'll end up paying a lot more interest. So they may have decided that it might make sense to try to swap out those cash flows for a fixed rate of interest. So because we're currently paying floating and we want to pay fixed, we're going to enter into a swap where we agree to pay fixed to the dealer and the dealer gives us back floating, which will offset what we're paying to our creditors. The idea here is to offset the LIBOR payments so that what's left is a fixed rate of interest. So imagine that we found a dealer who's willing to trade LIBOR to us for 6%. So how does that help? Because we are collecting LIBOR from the dealer, which is going to offset the LIBOR paid to our bondholders. So the total that we're actually paying now between this 2% and the 6 is 8. Okay, so in other words, we've traded, instead of paying LIBOR +2, we're now paying 8 altogether, net of all the cash flows. Now, as far as the actual transaction goes, we're not actually trading 6% for LIBOR. What we're doing is we're trading the difference between the two. Okay, that reduces credit risk. So in other words, in any period when the LIBOR exceeds 6%, the swap dealer sends a payment to the corporation equal to the difference. If LIBOR is less than 6%, then it's the other way around. And if LIBOR is exactly equal to 6, then no cash flows will change hands at all. Okay. Remember, the whole purpose of all of this is to minimize the credit risk, because with an over-the-counter product like this, there's always some counterparty risk. The swap dealer is a financial institution, and they do occasionally go out of business. So there's always some chance that there will be a default. And that's one of the biggest issues that they have to worry about. Or from the perspective of the dealer, the corporation, what if it's a triple B corporation? Well, you never know what might happen to them. So what will happen, the dealer will price the swap to ensure that the riskier corporations will pay more for their swap. So you'll see later on that the quotes are in terms of LIBOR, or actually treasury note yields typically plus some spread or other. Oh, the 8%, here's what we're going to do. It's on the top. The dealer, the corporation is paying LIBOR plus 2, and then they're paying another 6% to the dealer, but this minus refers to the LIBOR they're receiving from the dealer. So LIBOR plus 2 plus 6 minus LIBOR adds up to 8. So I've taken all the cash flows and combined them to come up with that 8%. All right, now, on the other hand, what if that dealer, the same dealer that we were just talking about, enters into a 5-year swap with a bank, and the dealer now pays 5.95% in exchange for LIBOR? So this is a lot like the example we were looking at in Wikipedia. And so here's what the dealer has done. They've locked in a guaranteed spread of 0.05% on a notional of $100 million. That's $500,000. Wow. So as long as there's no default, the dealer is sitting pretty here. Now, of course, the spread between what they're collecting, what they're paying will probably depend on the size of the transaction. For huge transactions, they can afford to have smaller spreads, but this is how they make their money. This is how all dealers make their money. It's like with currencies. You know from experience, when you go to a foreign country, when you go to that country, you pay more for the currency, and when you come back, you get less when you swap your currencies back into dollars. That's how they make their money. And from their perspective, they're doing you a favor. They're saying, listen, you want the currency or don't you? Okay, so that's how they make their money. And this spread between the two is a bid-ask spread, and dealers quote their rates. If you want to find out what a dealer's charging, you'll see that they'll quote a bid and an ask price. So like here it is. Let's say, for example, these are the different swaps that the dealer's willing to enter into. These are all fixed for floating rate swaps. And so the quotes are, if you notice, are in terms of treasury notes plus some fixed spread. So if you want to enter into a swap with this dealer for 2 years, they will pay you 2-year treasury note yield, whatever it happens to be, plus 20 basis points, which is 0.2%, if you want to give them LIBOR. If you want to receive LIBOR, you have to give them the 2-year treasury note yield plus plus another 20 basis points. In other words, if the treasury note rate is currently 2%, that means here you're paying, the dealer's paying 2.20%, but receiving 2.28%. And the 0.08% spread between the two is the dealer's profit. And as you see, as you go down the list, the spread between these two is getting a little bit wider. Okay, here it's 8, here it's 9 basis points, here it's 10, and here it's 50. And that's because the further the swap continues, the more credit risk there is. Right? In other words, the chances of your counterparty going bankrupt increase with every year that the swap is outstanding. So that's why the spread between the dealer pays and the dealer receives is increasing as we move further out on the maturity curve. Okay, and just a quick reminder, in case you hadn't run into this before, well, I guess you have, basis points are written, this is something used on Wall Street. 100 basis points is 1% or 0.01. 10 basis points is 0.1% or 0.001. And then finally, 1 basis point is 0.01%, 100% or 0.0001. Okay. In a lot of applications, it's just easier to use basis points than actual percentages. All right, especially like in the swaps market. All right, now here's another example. U.S. corporation issued $100 million with a 10-year 6% coupon bonds 5 years ago. So they're now 5-year bonds. And we're now looking ahead and saying, you know, we think interest rates might go down in the future. Maybe there's a way we could save on interest because these coupons are awfully high by today's standards. So guess what? We decide to approach a dealer. Okay, and we say, okay, dealer, here's what we want to do. So the corporation is currently locked into paying 6% to their bondholders for the next 5 years. The dealer is offering to give them 4% in exchange for that LIBOR. So the corporation is ultimately paying 6% to the bondholders. They're paying LIBOR to the dealer, but they're collecting 4% from the dealer. So their net cost of this is now 2% plus LIBOR instead of 6% fixed. And their feeling, of course, is that LIBOR will fall below 4%. Otherwise, this doesn't make any sense. So what they're doing is they're transforming their liabilities from fixed into floating with an eye towards saving money. Okay, they can't stop paying the bondholders, but they can try to change the way their interest payments are calculated. And the dealer doesn't care. As long as they get their bid-ask spread, they're not going to ask you questions like, what are you doing this for? Because remember, they're giving you a quote sheet here, and they're offering to take either side of these swaps, and these are the numbers that they're quoting. That's what a dealer does.
Sure.
They'll take a
Can you
position in
explain-
anything in exchange for the right payment.
Can you explain
Okay.
that slide? How do you get to 2.10 or 225? What's
Oh,
the
these were just whatever the rate happened to be on that day.
Oh,
Yeah, I'm assuming.
okay. Okay.
Right, yeah. So assuming that you look in the Wall Street Journal and today, these are the quotes that you see for the Treasury market. And then you look at the dealer's quotes, you could figure out how much they're actually offering to pay you or how much you're going to receive if you enter into that swap. So in other words, the dealer doesn't quote an actual number like 2.20%. They're telling you whatever today's Treasury note yield is, we'll pay you that plus 20 basis points. In exchange for that, somebody else will give us 2 years plus 28 basis points. It's kind of like when you go to a restaurant and there's no price for the lobster and it says on the menu market price. It is what it is, okay? They don't want to lock themselves into charging $30 for the lobster because tomorrow they might have to pay more for their lobster. So that one will always say market price. And you have to ask, how much is the lobster today? It's the same thing here. It depends on the Treasury market.
Okay, so where it says 2 years TN, the TN plus 20 BP, what does it mean? What is it, 2 years TN?
TN is a Treasury note yield, which we have on the right.
Okay.
20 basis points
it-
is 0.2%.
Okay, so the 2 years Treasury is how much? 2.2?
Yeah, we're assuming here that today the Treasury note rate is 2% for 2 years. And that means
Oh,
the dealer pays that plus another 0.2%.
Okay.
And over here, they receive, if you're trading LIBOR to them, or they're giving you LIBOR, you'll pay them the Treasury note rate plus another 28 basis points. So this is how the quotes are given. They're not going to give you actual numbers because they'll change every day. Just like I said, just like with the menus and the lobster prices, they don't want to print a new menu every day. So instead, the prices that are very volatile, they put in the menu market price or market quote. Okay. And so, it's not that unusual for that to happen with lobster. For steak, no. There's a number there, but for lobster, it's probably going to be market price.
So on the first example, if you're the dealer gives out LIBOR
Mm-hmm.
and gets 2%.
Right.
So who's making the 20?
Well, if you're giving the dealer LIBOR, they're giving you back 2.20%.
Okay. The deal when you said the dealer pays, is the dealer is giving out LIBOR?
The dealer pays, that means in exchange for LIBOR. It's always
Okay,
in
so-
exchange for LIBOR.
Oh, okay, so the dealer pays and receives that exchange rate.
Right, in
Or
exchange
LIBOR.
for LIBOR, right.
So if he gives that, and he gets like, so did he make money or what's LIBOR that day?
Well, they have to make money because in the sense that every time they make a transaction, they're giving you the lower of the two and they're receiving from somebody else the higher of the two. It's like, again, with the currency markets, you sell your currencies to a dealer for a relatively low price, but you buy them for a relatively high price. So the dealer is trying to make money on every transaction.
So LIBOR should be higher
Well,
than 2.20%?
No, the LIBOR could be anything.
I'm sorry?
The LIBOR here could be anything. We don't know what it is. It's not showing here. But remember, they're trading it. They're trading with you. LIBOR goes back and forth in exchange for one of these two fixed rates.
Okay.
Now, in a different interest rate environment, these numbers could look very different. I mean, it might be that, like in a different period of time, maybe the first quote would be 2-year Treasury note plus 120 basis points or something like that. That part depends on the level of interest rates in the market. But what's important is that they're locking in a spread in the first case of 8 basis points. So as long as they have a steady flow of customers who are both buying and receiving and paying LIBOR, they make 8.08% on the spread. And for $100 million notional, that's like $80,000, I believe. Let me just double check that. Yeah, $80,000. So as long as there's no default, they're making a guaranteed profit of 80,000, and that's for every transaction. In other words, if you're going to trade cash flows twice a year for 5 years, that's 10 trades, each one of which is profitable to the dealer.
Sorry, when it says dealer pays, the dealer pays that to get LIBOR, and it says
Yes.
dealer receive, the
That's
dealer
right.
receives that interest in exchange for LIBOR.
That's correct.
Okay.
Now, here's an interesting way in which this can be put to use. Sometimes you'll find cases where companies may want to borrow in different markets, and they find that there's a restriction of some kind. Like maybe a US corporation might find it to be terribly expensive to borrow in England, where they also have a division. And so what they may do is they may approach another corporation that's based in England, that's better known over there, and say, listen, we want to borrow pounds, but we do not have enough of a presence here to borrow at a reasonably low rate of interest. So what sometimes happens is, similarly to the World Bank and IBM situation, the two corporations may decide to borrow in the markets where their costs are the cheapest and then trade the cash flows with each other. And so this is what we're trying to do, is take advantage of something called comparative advantage, which means one corporation may have the edge in borrowing in one market and the other may have the edge in borrowing in the other market. So here, for example, you can see Corporation ABC can borrow at fixed for 5% and LIBOR for LIBOR plus 2 in the floating rate market. XX will have to pay an extra 2% in the fixed market compared to ABC, but only 1 extra percent in the floating rate market. So in economics, I don't know if you've ever had this, run across this concept before. Usually comparative advantage is applied to the area of international trade to decide which countries export what products. But here you could make the case that ABC has the comparative advantage. They actually can borrow more cheaply in both markets, but their advantage is more pronounced in the fixed rate market because they can borrow at 2% less rather than 1%. So I'm out of space here, but that means that XXX, I'll put it up here, I guess, XXX has the comparative advantage in the floating rate market because their cost is only 1% higher rather than 2. So here's what they're probably going to do. One way they can take advantage of this is for each to borrow in the market where they have a comparative advantage. And then they trade with each other. So let's see how that works numerically. So let's say ABC really wants to borrow at a floating rate because they think rates are heading down. XXX has the opposite outlook and they would rather borrow fixed. But XXX doesn't want to pay 7% and ABC doesn't want to pay LIBOR plus 2. So what do they do about it? Well, here's what they're going to do. ABC will go into the fixed rate market and borrow at 5. XXX will go into the floating rate market and borrow at 3, LIBOR plus 3. And then they agree to change the cash flows at the rate of LIBOR for 3.5%. So let me show it to you here. ABC borrows fixed 5%. XXX borrows LIBOR plus 3%, which is floating. But that's not what they want. ABC wants to pay a floating rate. XXX wants to pay a fixed rate. So they agree among themselves that ABC will trade LIBOR for 3.5%. Now, how does that help anyone? Because if you look on top at the net costs, ABC's net borrowing cost is LIBOR plus 1.5%. On the other hand, XXX net borrowing cost is 6.5%. So if you look at the original chart, let's get this down here. This is what they would have had to pay. So let's do this. Whoops. Oh, what happened? Oh, I know. So ABC is borrowing fixed. And XXX is borrowing at floating. And then they trade. ABC pays 5% to XXX in exchange for LIBOR plus 3.5. So as it shows here, the net cost to ABC, they're paying 5, they're paying LIBOR, but they're collecting 3.5. ABC's net cost is 1.5%. So this is with the swap. This is without the swap. Whereas XXX, their net cost of borrowing is 6.5. Okay, so what we can do here is say that with the swap, and so the whole point of this is that ABC has reduced their borrowing costs by 0.5%, because they would have, if they borrowed LIBOR directly, they would have had to pay LIBOR +2. Instead, the net effect of this is LIBOR +1.5, whereas XXX is paying 6.5% for fixed, but they would have had to pay 7. Okay. So that means that they're each saving 0.5% by doing this. Anyway, so I put together.
I'm sorry, I didn't understand exactly like the previous slide.
Okay, so so again, they borrow in each other's market basically. ABC borrows fixed, and XXX borrows floating at the rates we quoted up here.
Right.
But then they trade the cash flows with each other. Because ABC actually wants floating, they trade LIBOR to XXX for 3.5. And of course, XXX is actually paying the 3.5 to get LIBOR back. So
but
with it,
ABC didn't have labor. ABC had the fixed rate.
that's right. They're paying the company they borrowed from, or the bank they borrowed from, 5%. That hasn't changed. But what's happening is that they're now paying LIBOR to XXX, and they're getting back 3.5%, which offsets the cost of borrowing. And in fact, it lowers it so that the net payment that comes out of their pocket is actually LIBOR plus 1.5%. Okay, in other words, they're paying LIBOR.
Sorry, I didn't understand. So ABC is borrowing at a fixed rate.
That's right.
And it's 5%.
5, yeah.
Where is the 5% there? So they borrow, yeah. And then what did they give up their 5%? What did they give up?
No, that doesn't change. It's the swap that what they've done is they decided to agree to trade the cash flows with each other. So ABC agrees to pay LIBOR, and it's based on the same notional principle, by the way, which could be, let's say, $1 million. So now ABC is paying
ABC agrees to pay LIBOR in $1 million.
Right, and in exchange for that, they get back 3.5% from XXX, also based on $1 million. That's the swap part. They borrow.
And how much should I pay for the LIBOR?
Well, we don't know. It doesn't matter, because what matters is that they've locked in a payment of LIBOR plus 1.5%. Now, it might go up, and they might be sorry about it, but it's still cheaper than what they would have paid without the swap. That's the important detail. Not whether or not they should borrow floating, but whether they should enter into the swap. So the swap turns out to be cheaper than going directly to the floating rate market in the first place and borrowing at LIBOR plus 2. So they've reduced their borrowing costs by 0.5%. And then the same thing is happening for XXX. They are actually paying a net amount of 6.5%, whereas it would have cost them 7 had they gone directly to the fixed rate market in the first place. So they each saved 0.5% by doing this, by borrowing in their markets of comparative advantage and then trading with each other. And so that's one possible way that we can use swaps to not just necessarily change the way in which we're paying, but to actually save money. So this chart hopefully will help you follow along. You got here the amount that we actually paid to borrow. And then here we have what we're paying to our counterparty through the swap. And this is what we're receiving. Now the negative means it's an inflow. Okay. So the all-in cost, meaning the cost of all of these combined, is LIBOR plus 1.5% for ABC and LIBOR plus 6.5%, sorry, just plain 6.5% for XXX. What it would have cost them without the swap is here. And you can see in both cases, we've got 0.5% cheaper borrowing costs than what would have happened if we borrowed in the other markets.
Why is it cheaper? Do you know the price of LIBOR?
It doesn't matter what LIBOR is because we're still saving money compared to what we were going to do.
Mm.
Okay, it's still cheap.
But what if LIBOR went up really high?
Well, then that's a separate question because then ABC would not have done that. They must have felt in order to borrow fixed and then trade for LIBOR, they must have been under the impression that rates would drop. And if they're wrong, well, then they should have borrowed fixed in the first place. But as far as the swap goes, given that they were determined to borrow at a floating rate, they've still saved 0.5% any way you look at it, compared to what their original plans were. Okay, so there's no question about it. Whether this works out for them or not is a different question. What does matter is that they were able to save 0.5% by doing this instead of borrowing directly in the floating rate market. And so that is one way in which swaps can be used to our advantage, to potentially at least save money by borrowing in an area where you have a comparative advantage. All right, now this is the tricky part, pricing these things. Now, we're basically going to be applying two different approaches here. So let's see let's get this spreadsheet out and look at the interest rate swap. Now, there's a lot of details going on here. What example are we looking at? Let's try this example right here. 6 months ago, a 4-year fixed for floating rate swap was entered into. The notional is 100 million. So all that is on top here. And by the way, the coupon is the 5% of the 100 million. The floating rate at the moment, the 1-year LIBOR rate is 3.5%. That information comes later on, it looks like. Wait a minute. Oh, here it is. Here it is. Trying to see where I got that from. Oh, I see what happened. Okay, so I just want to take a little sidestep back here, just to remind us how floating rates actually work. Okay. Yeah, with a floating rate interest instrument like this, let's say that we have a swap that's reset every 6 months. Okay, so we have a fixed for floating rate swap. Payments are made every 6 months. Actually, I'll tell you what, let's keep it simple. Let's make it every year. All right, so here's today. Now, here's year 1. This is 1 year in the future. this is 2 years in the future. All right, and let's say this is 3 years in the future. This is a timeline. The floating rate that will be observed in 1 year is the 1 year rate that's observed here 1 year earlier. So in other words, whatever 1 year LIBOR is on day 0, I'm going to write this as L10, which means 1 year LIBOR rate observed at time 0, which is just today. Okay, whatever this number is, let's say it's, just to keep it simple, 5%. The floating rate on year 1 will be changed to 5%. I'll put it here. So in 2 years, let's say today, this is the 1 year LIBOR rate that's observed in year 1. Let's say it's 6%. That's the rate that will be, the floating rate will be reset to 6% in year 2. And then let's say this is L21, and that's 4%.
Shoot, I'm sorry, I don't understand. What are we doing here?
Oh, I'm showing how the floating rate side of a swap is actually calculated. So it's like, I don't know if you've ever heard of adjustable rate mortgages. What happens with an adjustable rate mortgage? What happens is every year the rate is reset, and usually higher, but it goes up. And how is it determined though? How do they decide? Well, it might be different with mortgages, but there's a floating rate of interest, which is reset every year. At least in the swaps market, the rate that we set today is equal to the LIBOR rate that we observed 1 year ago. Okay, so in other words, let's say today is 4, let's put some actual dates here. Suppose this is the reset date.
What, I'm sorry, what does the reset date mean?
The reset is when they change the floating rate of interest. In this case, in a swap. But it could also just as easily apply to an adjustable rate mortgage. So in other words, on 4/18 today, 4/18/22, if we're engaged in a floating rate swap with another counterparty, fixed for floating rate swap, the floating rate side today will equal whatever 1 year LIBOR was exactly 1 year ago today. 1 year later, we say, the floating rate now is whatever the 1 year LIBOR rate was a year ago.
Oh, why do they use 1 year ago? Why don't they use the spot rate?
This is the standard approach. I suppose they could do that, but this is normally how it's done. I don't know how this convention came about, but this is what would normally be done, at least in the derivatives markets. The floating rates are set one period earlier. They could have been done that way. But for whatever reason, these contracts are structured to always be looking one period back to determine the current rate of interest. This is, I don't know if there's another market where they do it differently, but with swaps, it's always been done this way. So 1 year behind is what the rates are. They're backwards looking rates, so to speak. And so that means when 4/18/22 rolls around, we now know what the rate will be on 4/18/23. Okay, we see that it's 6% now, which means in 1 year, the floating rate side of the swap will be 6%. So you always know 1 year ahead of time what the floating rate is going to be. I guess the market participants prefer it that way because if you wait to the last day, you won't know until that actual day what the rate will be. This way, you know a year ahead of time how much it's going to cost you to pay the floating rate side of the swap. So I'm guessing that this is what market participants prefer. And the same thing holds for floating rate bond, which they do exist. Most bonds have a fixed rate coupon, but floating rate bonds do exist where the coupons are set one full period ahead of time, which could either be 6 months or 1 year. So what we're assuming here in this example that we're about to look at is that we are now looking at a swap which makes payments every 6 months. Okay, every 6 months the rates are reset. And so this is what it would look like for 1 year. So instead, in this case, it's every 6 months. And so we're also assuming that the swap was not entered into today, but 6 months ago. So what that means, oh, wait a minute. Oh, I'm sorry. These are annual payments, but the swap started today. Now, by the way, I want to mention one more important detail here. Because of the way these floating rates are determined, this means that the price of a swap will be 0 on the reset dates. This means that the present value of the remaining cash flows from the fixed rate side will exactly match the present value of the remaining cash flows from the floating rate side. So of course, remember, there's two counterparties. One has the fixed rate side, one is floating. One side may be more valuable than the other. And so that determines the actual price of the swap. But on the reset dates, we're essentially starting all over again. The price, the net price is 0 because the value of both sets of cash flows are exactly the same. After that, they can be different. So in other words, we can't really have an example where we price the swap on the day it was issued because the price would simply be 0. So that's why in this example, we're assuming that 6 months have elapsed since the swap was entered into. Okay. That's the only way we're going to get a number other than 0. All right, so let's see how that works. Let's look at the example. So it's a 4-year swap. It was set up as a 4-year swap with annual cash flows, but 6 months have elapsed. So the next swap exchange of cash flows will occur in 6 months or half a year. And then the next cash flow will be a year later, and a year later. So if we create a timeline for the swap, you'll see that let's see if I actually did that. No, I didn't. So let me draw one right here. So the cash flows will look something like this. Here's today. And then these are the 1 year in the future, 2 years, 3 years, and 4 years. So LIBOR will be exchanged for 5%. So if you are the floating rate payer, every one of these periods, you will pay LIBOR. I'll put it as minus L. And down here, I will receive 5%. Oops, I got that backwards. So if I'm the floating rate payer, and remember, these are percentages up here too. These LIBORs are percentages of the notional principal. Now, in this case, the notional principal is $100 million. So that means that these numbers down here are all going to equal $5 million. The question is, what will those LIBOR payments be? And we don't know what they will be at the moment, but every time the cash flows reset, then on that date, we'll know what the next one will be. Okay, so the cash flows here, you can see will actually take place. Now, keep in mind that because this swap started 6 months ago, we have to adjust this cash line. So this, what we're seeing here is when the swap was entered into. This is what it looked like. Now, because it's been 6 months since the payment, the swap was entered into, we have to change the diagram a little. So here's today. Now we're going to remind ourselves that 6 months ago, we entered into this thing. So in 6 months, we'll call that time 0.5. It'll be the same thing, minus L, but it's this LIBOR rate that we're going to receive. And we're going to think of this not as time 0. This is time -0.5, meaning 6 months ago. So whatever the LIBOR rate was, that's what we're going to pay in 6 months. Okay. And then a year and a half from now, that rate will tell me what's going on here, et cetera, et cetera. Anyway, so let's look at the spreadsheet. And so the relevant cash flows will take place in 6 months, a year and a half, 2.5 years, and 3.5 years. The fixed rate is easy. It couldn't be any simpler. Each one of these is 5% of $100 million. And at the end, we're going to assume that we have 2 bonds here. If we bought a fixed rate bond like this, at the end, you would also get the notional principal. So we're treating this as if we were trading a fixed rate bond for a floating rate bond. Right? The fixed rate side, these are the cash flows that we'd be entitled to. The discount factor comes from the LIBOR curve, which we'll see here. Here it is. Here they are. These are the LIBOR rates. We look in the Wall Street Journal and we can see that these are the currently observed LIBOR rates, which we'll use to discount these cash flows. This is the so-called discount factor. What this tells me is that if this is the LIBOR rate, that means receiving $1 in 6 months is like receiving 98.82 cents now. So these are just present values right here. How did I get them? For example, this one, Now, where did all that come from? The 4% is here and the time is here. Okay, this is the rate. R is the rate, T is the time. And so this is 6 months from now with a rate of 4. That gives me 0.9802. That's my discount factor. The next one below it, I'm using a 4.5% rate of interest and 1.5 years for my time frame. So, you can reproduce those on a calculator if you want to, just to confirm that you're getting the same things. But what this means then is that having $5 million in 6 months is equivalent to having 4,900,993 today. So these are the present values, okay? And all I did in each case was multiply the cash flow by the discount factor. Okay, and then I do the same thing for all 4 of these and I get my price. This is the price that I would pay today for a fixed rate bond that has a face value of $100 million and a coupon rate of 5%. Now, what about the floating rate side? That's the tricky part. What is this all about? Well, we're going to say the following. And this comes back to, again, to the way these floating rates are determined a year in advance. What happens here is on each reset date, the following year's LIBOR payment is known. Okay, so therefore, the value of the floating rate bond can be determined as the present value of the bond's face value plus next year's LIBOR coupon. Okay, so if you look at the chart, you'll see that we only have one number here. That represents the 3.5. Oh, by the way, let me mention right over here. According to this, the slides, when this swap was first entered into, the 1-year LIBOR rate was 3.5%. Okay, that was 6 months ago. It's mentioned here somewhere. Yeah, at the time it was 3.5%, which means the coupon, the next coupon is 3.5%. 100 million times 3.5% is 3.5 million. So here you're seeing the price of a floating rate bond equal to the price, the coupon plus the face value. So we only have to discount that one once. The same way we did it here. This is the present value of 103,500,000 received in 6 months. So what I'm going to do now is add these up. And so what we've got here is the difference between the fixed rate side and the floating rate side. So we're going to treat the, oh, here we go. We have a chat. Oh, E is a constant. You can find this on your calculator if you look at it's approximately equal to, oops, hold on. It's one of these numbers that goes on and on forever, like pi, without repeating itself. It's a constant that's often used in derivatives models for calculating present values. And the reason why we use it is because it has several very convenient mathematical properties. And Hull's book uses these everywhere because he just loves continuously compounded rates. So if you're not sure, go to your calculator and look for the button e to the x and calculate the value of e raised to the first power, and you'll see. The other option is to go to Excel and just type equals exp1. That means e, and there's your number. But anyway, So the key to the whole thing here is that with a fixed for floating rate bond, the position of the fixed rate payer is equivalent to somebody who has bought a $100 million floating rate bond with a coupon of LIBOR, and they've sold to raise the money a $100 million bond with a fixed coupon of 5%. So this is the side of the swap who's paying fixed and receiving floating. Their position is the same as somebody who bought one bond and sold the other. Oh, because Hull's book uses E to calculate the present values of all the cash flows. All right, in other words, we needed to compare the values of cash flows that occur at different points in the future. In other words, we're calculating what's called the present value. So like here, for example, that means $1 received in 6 months is equivalent to having 98.02 cents today, which implies that having $5 million in 6 months is equivalent to having about 4.9 million today. We call that the present value. How much is that sum worth now? And that comes down to the rate of interest and the time frame involved. So if you notice here, these cash flows add up to, what is that, 120 million. Their present value is 100,601,000. So in other words, if I were to buy this bond, it would cost me $100,601,019 based on these interest rates. The floating rate bond would cost me $101,450,000. So anyway, to summarize that, the fixed rate payer in the swap has the same position as if they bought the floating rate bond and they sold or shorted the fixed rate bond, which means they paid 101 million and they received this amount. And so,
Are we talking about two different type of bonds here or just one?
well, we're treating the two sides of the swap as if they had traded bonds with each other. In other words, if I enter into a swap with somebody as the fixed rate payer, so let me summarize this down here. Entering into a swap as the fixed rate payer is equivalent to doing two things. Buying the floating rate bond, selling the fixed rate bond. Okay, so that this investor is paying a fixed rate to the buyer of the bond and receiving a floating rate from the seller of the floating rate bond. So the cash flows to this position are exactly the same as being in a fixed rate interest rate swap. Entering into a swap as the floating rate payer is equivalent to the opposite, buying the fixed rate bond and selling the floating rate bond. And then this investor is paying a floating rate to the buyer of the floating rate bond and receiving a fixed rate from the seller of the fixed rate bond. So the price of the swap equals the net difference between the value of the fixed rate bond and the floating rate bond. The price will be positive for one counterparty and negative for the other counterparty. The sum of these values will always be 0. Okay. So what we did up here was we calculated what this fixed rate bond would be. The equivalent fixed rate bond would be worth about $100 million. The equivalent floating rate bond is worth about $101 million. So that means the fixed rate payer has a position that's worth a positive $849,542 because they own, remember, it's as if they own the floating rate bond, but they've sold the fixed rate bond. So they own something that's more valuable than what they sold. Now, the floating rate pair is on the opposite side. Their position is negative, okay, because they own this bond and they've sold this bond. So they're behind. They're behind the 8 ball.
All right,
Their
I'm
position-
sorry. If you go back to the graph,
Mhm.
to your numbers there. So, no, to the Excel. It's fine.
Oh, Excel, okay.
Yes, to your table. So, okay, so we have fixed rate bond. This is the payments that the bond would issue, right?
Yes, if you own a fixed rate
And
bond, these are
what
the
is
cash
the
flows.
What is the FRN?
Oh,
calculation?
FRN stands for floating rate note.
Floating rate note.
Yes,
So is that the price you pay for the note at that point?
yes.
or-
Well, that's the cash flow. The present value of that is what's relevant. The price equals the present value of the bond's cash flows. So the price of the bond is $101,450,562.69. That's how much I would have to pay to buy that bond right now and collect those cash flows in 6 months.
Sorry, so what is 101?
So I didn't hear that, sorry.
Which numbers are you adding for to have 101,450,562?
Oh, it's just the present value of this. There's only considered to be a single cash flow because we know from today's perspective what the next coupon payment will be.
Okay, I'm sorry, what numbers add to 103,500?
Oh, over here. The
Okay,
notional and the
so-
coupon.
Is the principal plus 3.5%?
Yes, exactly.
Okay, so what is that exactly?
Oh, because the bond, because it's a floating rate bond, on every reset date, it
Uh-huh.
has a known coupon, which means that the market price will be equal to the face value of, or notional value of $100 million. And on top of that, we're receiving a coupon payment of $3.5 million. So from today's perspective, we know what the value of the bond will be. And that value is $103,500,000.
Okay, so the bond is for $100 million. And the
Yes.
value in 1 year would be 1 million plus, I'm sorry, 100 million plus the 3 million. in
Right.
interest.
Right, because that's the coupon payment. That's the LIBOR
Yeah.
coupon. And
So,
so the value today is equal to the present value of that.
so the present value of 103 million, it's 101.
That's correct.
Okay, and what about the 5 million fixed rate bond?
Oh,
cash
that's
flow?
the fixed coupon rate on the fixed rate bond. It
Is it a
says in the
different
cover.
one?
Yes, it's $100 million face value or notional value, but it has a fixed coupon of 5%.
Okay, so that's a different bond. So we're comparing two different bonds,
Yes,
one with a floating rate, one with a fixed rate.
that's correct.
Okay, and what are we using the discount factor for?
We're using the
that's
LIBOR
a-
rates. The LIBOR rates determine these discount factors.
to find the present value of the fixed rate, or to which one? Oh, the
Of all
present
the
value
cash
of the,
Right. They all come from these discount factors, which are based on time and LIBOR.
Were the discount factors calculated or those were static?
No, I count, there's a formula in here. Look,
Sorry.
oh, that's right. That's
Oh.
how,
Oh, I see. Okay.
sorry, so we're using the discount factor
Mhm.
for, to calculate which numbers? The
Okay, the
present
discount
value,
factor, that's where these come from,
where
this
you-
number-
to calculate the present value of what?
of these.
Of the, of.
The
okay,
fixed
of the
rate
fixed
bond
rate.
cash flows are discounted over here. And all we have to do is multiply these numbers by these numbers. The actual cash flows times the discount factor gives us present values. And that's what these are. And when we add these up, this is the market price of this bond.
So that's
Okay.
for the fixed rate. So then we calculate the present value of each cash flow, and we have the present
Right.
value of the fixed rate bond.
That's
And for the floating rate bond, we only have the total value, and then we take from that the present value.
that's right.
Why don't we have, there's no cash flows?
Well, no, the cash flows are considered to be, we're treating it as if we were holding it only for 6 months, because at that time, the price of the bond is guaranteed to be worth its face value of $100 million. So we're saying that this bond in 6 months will be worth $103,500,000, because the same thing will happen at every reset date. We'll get a bond worth $100 million plus another $3.5 million worth of a coupon payment. So we
Why
don't
are we
need,
Why are we comparing a 3-year bond with a 6-month bond?
well, because the key difference is that the values, the future coupons are not known to us today for that floating rate note. But what we do, those future, we don't know what the future LIBOR rates will be. We don't know what the future coupons are for that floating rate note. But what we do know is that in 6 months, it will be worth $103,500,000 guaranteed. So we use that. So we're essentially pretending that we're going to sell it in 6 months. And then its present value gives us the price that you would pay today.
Mhm. But why, okay, because the floating rate bond was issued before, right? Because otherwise you.
They were both issued 6 months ago, right? And that's why we already know, we know what the next coupon payment will be for the floating rate note, but not the ones after that.
So when was the fixed rate bond issue? If the bond is for 100,000, why do you pay 101?
They were both issued 6 months ago.
So they're gonna be paid at 1 year maturity.
Well, they'll be their annual coupons. So because the bond was issued 6 months ago, the next payment is due in 6 months.
Oh, this bond pays every 6 months.
No, every year. But since 6 months have elapsed since the last payment, that means the next coupon is due in 6 months.
So when was this bond issued, for example? Did
6
you
months,
set up a date?
6 months ago. They were both issued 6 months ago.
So, like November. So the floating rate bond was issued in November,
It was issued
and
6
then-
months ago.
like in November, for example, like we're in April
Yeah,
now.
in November.
So,
okay.
but it was issued for 100,000,
100 million. They're both
100 million. Why didn't we pay 100 million like in November?
Well, they both are selling for 100 million. In other words, remember, these are two fictional bonds that don't actually exist. In order for this, we're trying to line them up so their cash flows matched with those of the swap. So we're treating this as two fictional bonds. The fixed rate bond sells for 100 million and it pays a coupon of 5 million per year. The floating rate note sells for 100 million in the beginning, and then it carries a coupon initially of 3.5%, but that will change later on. So those are the known cash flows to these two fictional bonds, but those are also the cash flows to the swap. So that's why the value of the swap depends on those numbers, because even though those two bonds don't actually exist, the cash flows that we're seeing are the ones that are relevant to the swap. So
I-
therefore,
I just don't know, why are we paying, if 6 months ago, if today the floating rate note is 100 million, why are we paying 101? Why
it's
is it
not
worth-
though. No, because in 6 months, we also get a coupon. So the price is going to be more than 100 million. Because we have to take into account the coupon that we're getting in 6 months.
I don't understand, sorry. If
See,
they're
you-
issuing $100 million bond, how come I'm not paying 100 million? Why do I have to pay 101?
Because that will include the cash flows that are still coming to us.
So
A bond,
If
a
the
bond is like a
government-
loan. A bond is
I'm-
equivalent to a loan. It's like if you borrowed $1 million from a bank, you're going to pay them back more than $1 million. So it's the same thing here.
Oh, I see. Okay, so I am not the borrower. I'm buying,
You own a bond. Yes, we're treating this as a bond that you could buy in the marketplace. So because I paid
So
100 million for the bond,
somebody else borrowed the money. I bought the bond. So
Yes,
it's 100,
okay.
somebody got the 100 million. I just had the bond.
right?
And
so
my
you're-
bond, oh, I understand now.
Yeah,
I
you're
just, I'm
entitled
sorry,
to
I
those
just
cash.
need to understand the basics.
Okay, so anyway, but what this enables us to do is see that the value of the swap is zero to both sides together. But it means that the fixed rate payer has a position that's worth about $850,000. And the floating rate payer has a position that's worth about negative $850,000. So if they were to agree to terminate the swap early, which they can do, the floating rate payer would have to be prepared to pay $850,000 to the fixed rate payer, because that's what the swap is worth. So that's why that number matters, because if they do agree to terminate the swap, which does happen sometimes, we have to know exactly how much money would trade hands from one counterparty to the other. So anyway, so then that's the fixed rate bond. We also fixed for floating. We
So,
also need to consider the currency swaps, which are coming up next. And with the currency swaps, so, and in the slides, I have all the details as well. With the currency swaps, you're basically trading, for the most part, two fixed rates of interest, but they're denominated in two different currencies. So you might be trading 5% in dollars for, let's say, 6% in pounds or something like that. And so that means we have to take into account the exchange rate in these cases. And we need to also take into account the fact that exchange rates change over time. And the way we do that is to look at forward exchange rates, which we identified a couple of weeks ago. You might recall this formula that we introduced. Let's see if I have it here. Well, if not, I'll just remind you right here that the way that we calculate a forward exchange rate is in the following formula. A forward exchange rate is the price paid for a currency for future delivery, not immediate delivery. That's the spot exchange rate. This is determined as. And so it's basically F equals, you take the spot exchange rate, and then there's that E again. And then this is an exponent, by the way. Let me just tidy this up a bit. Okay, and I just want to remind you what these terms mean. Let's see. Okay, so I'm going to run out of space here, I can tell. Let's just continue it on the next page. Oops. And then R is the domestic rate of interest. And Q is the foreign rate of interest. And T is the time in years. And so just as a quick example, just to remind ourselves how this works, if you were told, let's say that the spot exchange rate between the dollar and the pound let's say $1.50 per pound. And the US rate is 3% and the UK rate is 5%. The 6-month forward exchange rate would be, and so keep in mind that 6 months is half a year. So you're going to end up with F equals 150 e to the, and again, I'll have to put in the superscript separately. And so if you take out your calculator, you'll see that that's equal to approximately 1.485 dollars per pound. So that's a forward exchange rate. So in other words, I can buy all the pounds that I want today at $1.50 each. But if I want to buy them in 6 months, I can lock in the price right now in a forward contract for 1.4581 each. Now, that matters a great deal with currency swaps, because what we need to do is not only calculate the future values, or sorry, present values of our cash flows, but for the ones that are coming from the foreign currency, we have to convert them into dollars. We're not going to convert them using the current spot exchange rates, because those won't be relevant in the future. We're going to use the current term structure of forward exchange rates to convert all of our foreign cash flows into dollars before we discount them. So it's a little bit messier than when we had just straight ahead interest rates. Luckily, it's all set up for us. And now here I've got two equivalent ways of doing it. I think what I'd like to do is use the more straightforward one. Well, actually, maybe we'll have time to look at both of them. We'll start with this one because this one does involve the foreign exchange market. So, all right. So since it's pushing 8 o'clock, what I'd like to do is stop and have our break right now. And when we get back, we'll look at this example, which is a currency swap with dollars for pounds, where we're trading a fixed rate in dollars for a fixed rate in pounds. And we want to understand how this swap can be priced in the marketplace. Okay, what is it worth to the two sides of the contract? All right. So, all right, we'll stop for a bit, and when we get back, we'll dive into this. And it's really hardly any different than what we were just doing, except for that extra complication of the exchange rates. But beyond that, it's almost the exact same approach. All right, so let's go, and we'll be back, I guess, in about 15 minutes, and then we'll carry on from here. Okay. Oh. All right, then, let's see how this works. All right, like I said, it's not going to be radically different because we're still thinking in terms of trading bonds. But actually, let's do this one first because this one is exactly like trading two bonds. The other approach is a little bit different. So here's what's happening. A corporation, US corporation wants to invest in a 5-year, 100,000 pound British bond with a 6% coupon rate. But they're concerned that the dollar will appreciate, which would reduce the dollar value of the pound payments. So they enter into a swap with a dealer in which they can trade their pound payments for dollar payments. Now, 6% of 100,000 pounds is 6,000 pounds. So every year they're entitled to receive 6,000 pounds. But let's say that at the moment the exchange rate is $1.90 a pound, which means that that would be worth $11,400 a year. Unfortunately, we don't know if that's going to last for the full 5 years of this swap. So what do we do about it? And by the way, here's why what we're worried about. The dollar appreciates to $1.80 per pound. That means that same coupon payment of 6,000 pounds is only worth $10,800 US. So this is what we're concerned about. Not that we're going to have a default by the other counterparty, but that the dollar value of our pound payments will shrink over the years if the dollar gets stronger. So here's what we agreed to do. We're going to go ahead and buy this bond. But what we're going to do in addition to that is we're going to enter into a swap where we pay a pound rate of interest to the dealer and we'll receive in exchange the interest payments in dollars from the dealer. Now, one important difference I want to mention up front here between currency swaps and interest rate swaps is that the notional principal is actually exchanged at the beginning and the end of the swap. That was not true with the interest rate swaps. All we had was cash flows based on the differences between the interest rates. There was at no time an exchange of notional principals. And it would have made no sense anyway, because in the last example, we would have been trading $100 million for $100 million. But now, since the principal amounts are in two different currencies, then we do need to trade them with each other, and then we'll receive them back at the end. Okay, so we have to take that into account when we price the swap. So here's what's going to happen. We're going to pay 6% in pounds to the dealer. They're going to in turn give us back 5% in dollars. The spot exchange rate is $1.90 a pound. So we are going to give $190,000 to the dealer. They're going to give us 100,000 pounds. And then we're going to use that money to buy the bond, the UK bond. So we're using $190,000. We trade that to the dealer for 100,000 pounds, which we can now use to buy the British bond. And that's what will be used to determine the size of the payments in this swap. Because remember, they're both fixed rates. So what's separating the two is one is based on dollars, one is based on pounds, but we know that the pound payments can change in terms of dollars over the years, over the years. So let's see, here's the diagram. And so in terms of dollars, what's going to happen is that in the beginning, let's see if we can do this as a separate diagram here. Here's the US corporation. Here's the dealer. So US corporation is paying 190,000 for 100,000 pounds. This is in the beginning. And at the end, the payments, I'm running out of space for the diagram. I'll just say that the payments are reversed. So we don't want to forget about that detail. Here we're actually trading the notional principals in the beginning and in the end. In the meantime, then 5% of $190,000 translates into $9,500. That part is locked in advance. And the 6% of 100,000 pounds is 6,000 pounds. Okay, so now we know what the cash flows are. The question is, what are they worth to us right now? So let's jump ahead here and look. And so you can see what we're going to do is treat these as two separate bonds, a US dollar bond and a British pound bond. And the US dollar bond has the following cash flows. The UK bond has these cash flows. Now, we're also told somewhere in here, the rate of interest in the two countries, it's way out here somewhere, are 3% in the US and 5% in the UK. That's what we will use to come up with our present values. All right, the two rates, 3% for the United States, 5% for the UK. So what we're going to do is calculate the present value of these cash flows and add them up. And that means this US bond is worth, at the moment, $206,985.33. By the way, I've also repeated the diagram over here in case we lose track of what's going on here. As far as the pound bond is concerned, we can do the same thing with the British rate of interest. And that means that that bond is worth 103,765.92 pounds. Now, this number right here is the important one. The exchange rate at the moment is $1.90 per pound. So right now, the way things stand, these pounds are worth $197,155.24. So the corporation who's paying pounds for dollars has the same position as if they had bought a dollar bond and sold a British pound bond. So therefore, they're ahead of the game because the position that they're long in is more valuable than the position that they're short in by 9830.09, which implies that for the dealer, everything works in reverse. All of these are the negatives of these numbers. And so the two positions add up to zero, but the bottom line is the corporation in the US is ahead of the game by 9830. Okay, at the moment. Now that could change. If the exchange rate between the two countries changes, then the value of these two will change. In fact, I could show you to you in Excel. If I change this to, let's say, $1.80, all of a sudden, the value of the swap is very different. Well, it's not that much different, but it is different. And so the great thing about using Excel is that I can change it to anything I want and see what the values will be. Okay, because that's the only part that can change now. There's no floating rate of interest, but instead what we have is a floating exchange rate, which will determine the value of the swap. Now, as far as the forward exchange rates go, this second approach is a little different because what we're doing here is we're going to assume, instead of treating the swap as a series of forward exchange, as a series of bonds, instead we're going to treat it as a series of forward contracts. Okay, so in other words, in this model we're looking at here, the swap is treated as an exchange, or I should say not an exchange, a series of forward exchange contracts. All right, I guess I should say forward contracts on foreign exchange. better. So in other words, it's an equivalent approach. And so what we're doing here is we're lining up the cash flows from the two bonds. And then we're calculating the forward exchange rates. Now we use this formula, we have to recalculate it for every year for the next 5 years. And so the details are here. But you can look at Excel and see that we use this formula to calculate the forward exchange rates going forward up to 5 years. So what we're doing here is we are now repricing the pounds in terms of dollars using the forward exchange rates. In other words, 6,000 pounds in year one is equivalent to $11,174.26. In year two, 6,000 pounds is worth the equivalent of $10,953, and so on. So when we add these up, and by the way, what we're going to do now is calculate the net cash flow, which means as the US owner of the dollar bond, this is how much it's bringing in, and this is how much I'm trading to the dealer. So my net cash flow as the owner of the dollar bond is here. And for the most part, I'm in the red, but down here at the end, I'm in the black again. So when I add these up, I've actually got 11,878.84. But now I'm going to calculate their present values using the US rate of interest. And look what I've got, the exact same result. It has to be the same in using this approach or this approach. Remember here, the foreign exchange swap or the currency swap is equivalent to an exchange of bonds. Specifically, an exchange of a floating rate bond for a fixed rate bond. Oh, wait, sorry, I'm thinking the wrong one. Sorry, wait a minute. No, my mistake. Let's get rid of that. It's equivalent to a exchange of a fixed rate dollar bond or a fixed rate pound bond. Okay, so that's what we're doing here. Now, one side is in the position of buying the dollar bond and selling the pound bond, and vice versa. Okay, so you can see the corporation is in the position that they own the dollar bond, they're short the pound bond. The dealer is in the opposite position. But here, we're treating these as forward contracts on foreign exchange. And so that's why we need to incorporate the forward exchange rate, because this tells us how many dollars these cash flows are worth in the future, so that we can then discount them back to the present using the current spot rates of interest. Either way, we'll get the same results. Okay, there's no getting around that. So, okay, now we can briefly consider the other types of swaps that trade in the marketplace. And like I said, I mean, no matter what swaps you think there are, there's always plenty more available, because you know, no matter what different market participants need, they can often arrange it through a swap. Swaps are over-the-counter products, therefore they can be arranged or customized to suit any needs you can possibly imagine. But some of the more common ones are going to be, actually, let me go in here. I don't want to lose this wonderful information that I'm putting in here. Okay, just to make sure that it's clear, I'll put this in Brightspace with the original version anyway. So that way you can see that I've added a few details here. You know, there's always room to improve any notes. You know, I always love to keep updating them and adding more good information. So anyway, but let's look at some of these other ones. Now, an equity swap means that you presumably have some portfolio of stocks. Let's say you've got the stocks in the Standard & Poor's 500. what you're basically doing is taking the return to those stocks, which includes both capital gains and dividends, and you trade them for a floating rate of interest. Okay, now why would you do that? Well, if you think the market isn't going anywhere, it's heading down, but you think that rates may be heading up. Let's say a recession is coming because rates are going up very quickly. What you can do is say, listen, I don't want to sell my stocks, but for the time being, I'm very nervous about the returns. So therefore, why don't I trade the returns for a floating rate of interest? Because I think the Fed is tightening anyway, what the heck? And so if the stock market goes down and interest rates go up, this swap could make me an awful lot of money. Now, like any other swap, it would involve a repeated series of payments. And every 6 months or a year, we would recalculate the returns of that equity portfolio and the floating rate of interest, which would be tied to LIBOR or SOFR or something equivalent to that. So that's what this would be for. It's basically a way of speculating on the entire market at once. So let's say that a pension fund owns $1 million worth of IBM stock, and we're worried about their future performance, but we don't really want to sell the stock. So we enter into a swap where we pay the return of the IBM stock to the dealer, and they give us back LIBOR. Now, of course, in this case, we only trade the difference. No notional is traded. We only exchange the difference between the two interest rates, our rates of return. And so what we're doing is we are trading the risk of falling stock prices for the risk of falling interest rates. Now, what about commodity swaps? A commodity is a standardized product that is typically used to make consumer goods and services. Let's say, for example, we have gold and silver are commodities, but we also have industrial metals like nickel and copper and zinc. Also, there are a lot of agricultural commodities like wheat and pork bellies. We also have grains. We have coffee and sugar and other goodies. So there's a lot of different kinds of commodities that we can buy and sell in the marketplace. And what we're effectively trying to do here is trade the return to these commodities for some type of rate of interest. So for example, a fixed for floating rate commodity swap is like an interest rate swap, except that the floating rate is based on an index, a commodity index, which does exist. There's an organization called the Commodity Research Bureau, and they have every month their own index called the CRB index, which reflects the prices of all these different commodities like metals and textiles and foodstuffs. And so if we believe that we understand how commodity prices will go in the future, we may be able to make money from that. For example, the commodity for interest rate swap means that we're trading returns of the commodities for a floating rate. Although I'm sure you can negotiate a fixed rate as well. Okay, so anyway, a forward swap is a swap in which it doesn't start right away. You might say, well, I want to swap fixed for floating, but not for 6 months. And so that becomes a forward swap because what you have in effect is a forward contract for both commodity and equity. The underlying is usually an index with these two swaps. It's not a single stock or a single commodity normally. It's an entire portfolio of stocks or commodities. Although I'm sure you could arrange it any other way. I mean, if you wanted to trade the returns to Apple for a floating rate of interest, I'm sure it could be done. Or the returns to gold, you could trade it for a fixed rate of interest. Of course it could be done.
All right. Sorry, just to jump in real quick. I was typing too slow.
Oh.
So in both of those instances,
Mm-hmm.
does trying to think of the right way to phrase the question. Okay. You have a payer and a receiver in a swap.
That's right.
The underlying is either an equity or commodity index, let's just say, or equity.
That's
index
right.
or commodity
That's
index.
right. Mm-hmm.
But you're really exchanging the cash flows based on either a floating rate, can be whatever, LIBOR, SOFR, but the other side of that Are you saying that this is the returns on the index?
Yes,
Okay.
that's right. Like, for example, if the Standard & Poor's goes up 5%, that's what you're trading for a floating rate or something
Okay.
like that.
I see.
It's the actual rate of return, and it has to be calculated by somebody at the end of every month or every 6 months.
I see.
So
So you're not actually getting that. So it's not an actual, you're not actually taking delivery like a.
No, there's no
contract.
deliveries here. No,
Right.
the only time we had delivery was when you traded for the currency swap, you traded one currency for another at the beginning, at the end. But in these cases, it's literally just a straight transfer of the difference between some kind of an index and either a fixed or floating rate of interest. So it's just the difference between the two. So there's no delivery like there would be with a forward contract, let's say.
Classic hedging instrument.
Classic hedging, right? But
Yeah.
what's interesting about this is that imagine you're a farmer
Yeah.
and you're worried about the price of your crop.
Right.
You can enter into a contract which says every year at this time, when my crops are ready, I want to trade the returns to that corn, let's say, for some fixed or floating rate of interest, because that way I have less risk. So
Right.
that's exactly when it would be useful.
Got it. Yeah, super helpful. Thanks for clarifying. that.
Okay. So forward swap means that you can start it in the future. Most swaps start right away. Of course they do, but you can enter into a contract in which we agree that in 6 months, I'll be the fixed rate payer and you'll be the floating rate payer with this, certain notional principle and all the rest. All the details would be spelled out, but it would mean that we don't start right away. So in other words, you don't have to necessarily start immediately. A long forward swap means that you are the one who's going to enter into this fixed or for floating rate swap as the fixed rate payer, where the swap rate is fixed into the contract. If you're the short in this position, you're going to be the fixed rate receiver or floating rate payer. Either way, the swap or fixed rate is set in the contract. The floating rate, it is what it is. The LIBOR will change every day. So you're just locking in the fixed rate with these contracts. So, and then I did mention before, although you don't see it here, there are also swaptions, which are options written on swaps. You have the right to enter into a swap with a specific, let's say for a fixed for floating rate swap, what would be locked into the contract would be the the fixed rate. And there's also all sorts of other possibilities, any types of situations where somebody has exposure to any kind of financial asset and would like to trade it for something else, then the potential exists to set up a swap. It's a very powerful and flexible concept. And this is why once the idea was dreamed up in 1981 by the World Bank and IBM, it caught on like wildfire. Everyone said, oh my God, what a brilliant idea that was. Why don't we try this with our own clients? And well, the volume of trading in these swaps is absolutely astronomical because they're so powerful and flexible. But anyway, so we really just focus on the two basic types, currency and interest rate swaps. But the others are very popular too. And you'll see a lot of them. Like I said, if you're a farmer, you might be more interested in the commodity swaps, depending on what kinds of exposure you're facing.
Swaption is only for interest rates though, right?
No, options are available, as we'll see. You can get options on literally anything. Swaptions are, I see what you're saying. No, the swaptions are typically based on interest rate swaps, but they don't have to be. You can make other arrangements too. But yes, most swaptions are in fact based on fixed for floating rate swaps.
Right.
That's true.
Cool. Thank you for that.
And we'll see how that works. But first we have to study options more carefully. Now, we're going to see a lot, and I mean a lot of discussion about options, because let's face it, they're like the king of the derivatives markets. So week 4 is their introduction to options, 5 more options, 6 pricing models, 7 risk in the Greeks. This is about risk management of options, and then 8 is more about general risk management for all securities. So we're going to be spending a lot of time with options. We're going to learn what they are, what their features are, how they can be used for hedging strategies, how they can be used for speculation, and how they can be priced in the marketplace. and how the risks of holding options can be measured properly, and how they can convert the risk of a portfolio of, let's say, stocks into something that's more appropriate. So that's going to take up the majority of the rest of the course. But when you see it, you'll realize that options are the most powerful. They're also really the most interesting of all the derivatives. And of course, as you probably know, many disastrous derivatives losses were pretty much based on options because they're so heavily leveraged, even more so than the others. I mean, really, you could really clean up if you know what you're doing with options, but you could also really get clobbered very easily. And so that's why people like Warren Buffett refuse to touch them, because they don't really understand them properly. So, all right, anyway, so variance swaps, let's see, let's go look up the exact payoff profile to a variance swap. I didn't include that one here. A variance swap is designed to help us hedge volatility. In other words, volatility meaning that the markets are changing very quickly. So the actual payoff to a swap, let's see, I'm not sure if they're explaining this very well. Oh boy, let's try another source. This is all in Hull's book. It says here the payoff is the notional value, of course, multiplied by the difference between a realized or actual volatility and the volatility strike price. So in other words, if the contract, the option contract, the swap is for, let's say, you're trading the volatility of the S&P 500 index for some constant volatility like 10%. Then, obviously, if the volatility goes up above that, you'd get a positive payoff. If it goes below that, you would lose money. So, but volatility refers to the uncertainty associated with the returns to a financial asset. And it's usually measured by the standard deviation of the returns, or possibly the variance, which is just the square of the standard deviation. So that's why it's called a variance swap or volatility swap. We'll get, I guess, maybe we can do that later on, but volatility is an integral part of option pricing theory, because realistically, the majority of the value of an option comes from volatility, because the option is what gives you the ability to hedge volatility.
That's slightly different though, right? Because, and thank you for doing this, but this is a vol swap.
It's a swap. It's not an option. But
well, no, I mean, sorry, but a variance swap and a volatility swap are different.
They're
right?
slightly different, but they are an
Okay.
attempt. They're giving you the opportunity to hedge the same risks. It's just that they're structured a little differently. Yes, you're right. Volatility swap and variance swap are slightly different. The payoffs are structured differently, but the same. You're using them both for the same purpose. Okay, because the variance is just the square of the volatility is the standard deviation of the returns. The variance is the square of the standard deviation. So the payoff is structured a little bit differently, but it is still the same type of hedging strategy. So
Thank you.
okay, sure. Anyway, so I guess we can stop right here. We're done with everything we need to know for swaps. And now, like I said, the focus will be now, by the way, what's great about options is that not only can we continue to use Excel, but we can learn a lot from just diagrams. Diagrams will prove to be incredibly useful in understanding the properties of options, especially trading strategies. So we're going to have a lot of fun with that. Now, there's some math involved, but we can do it all in Excel, so it doesn't need to be overwhelming. I will send you a template when the time comes that will help you set it up properly, and you'll see that yeah, it's a little complicated, but if it's set up properly, it won't be very difficult at all. So that's what we have to look forward to. So, all right, anyway, so I will post a bunch of good stuff on Brightspace again. I will make sure everything is working properly. Now I know about that quirky thing about the download. And I'll remember to turn off that eyeball for every one of them. They assume you don't want anyone to be able to see it unless you tell it otherwise. So that's why that happened. And so I'll be more careful with it, but I think we're all set with the Brightspace. It seems to be working. It certainly works a lot better than what they had before, that's for sure. I don't even remember what it was called, but it was terrible. So, all right, anyway, so if there's no last minute questions, I'll see you all next Monday.
Sir,
Yes,
may I ask one question? Is it okay?
Sure,
if I
go
ask a
ahead.
question regarding it's something off topic, but about contango.
oh,
The futures?
Contango, you know what? That has to do with the relationship between futures prices and spot prices.
Yeah, I was
It has to do
wondering.
with the pattern, whether they're going up or down as we get towards the maturity date.
Right, and I was wondering, like for example, with oil, if say with contango, price today, say it's $100,
Mhm,
and then next month it goes down and it say it's 80,
right.
hypothetically, is that a accurate prediction of a future price of the oil?
Well, that's a very interesting question. And a lot of people have dedicated a lot of thought to that. And the answer is nobody seems to be able to show that it is or it is not. It's it might help us think about what direction oil is people think it's going, but I wouldn't base a trading strategy on that either,
Okay.
because you never know what could happen in the future. The reason why you can't be sure is because there's no arbitrage opportunity if there's a discrepancy between the futures price and the spot price, or the pattern. See, it's not, we know that the futures and spot price have to be the same at maturity, but prior to that, they can be anything. And the contango pattern doesn't guarantee that, we'll make money or lose money from any particular trading strategy. It's not an arbitrage relationship. So you might use it to help you think about what's happening in the future or maybe plan, but I wouldn't use it as a trading strategy.
Okay, so there's no certainty to it. It's just like
No,
guidance,
there isn't,
guidance.
unfortunately, no.
Okay. Thank you so much.
Okay, sure. All right. So I guess I'll wish you all good night.
Thank
Good
you.
night.
All right, bye.